Well, our next guest sees a magic number on the 10-year yield that could wreck the market's hottest trade. Let's bring in Mike Wilson, Chief U.S. Equity Strategist at Morgan Stanley. Mike, great to see you. What is that magic number in your view?
Well, I wish that I knew that magic number. I'm not sure any of us know that there's a specific number, but as James was listening there on some of the numbers, I think maybe from my note around this idea that there's just not a lot of wiggle room now, where if you get a 50 to 100 basis point move in the 10-year that's abrupt, you're going to see some valuation compression. And then to Guy's point, it may not be bad for the resource stocks of the banks, which is what we've been preferring. I mean, look, this is core to our call. It has been since April. We first said that maybe this cycle we actually are going to get inflation. People thought we were nuts because we were in a pandemic. But the reality is that the policy response this time has just been very, very different, right? It's quantitative easing, money printing, but then it's being distributed freely into the economy where it's being spent. And so you've actually created incremental demand. You're running above where you were in many areas on demand in the economy as the supply is probably going to be somewhat impaired. So you're going to get inflation. Mm-hmm. And I think as Steve said correctly, we'll have to see if the Fed views it as being transient, temporary, or they start to think it's more permanent. Look, I don't think inflation is a problem for the market. This is what we need. If we don't get inflation, then we got a serious problem, to Tim's point. So I'm bullish because of this, but I'm bullish on the parts of the market that are going to benefit from higher rates and higher inflation. It doesn't mean the market can't go down. It can. We've been talking about this idea for 6 months where the average stock is doing better than the index. It's a mirror image of what's going on for the last several years. And part of that story is interest rates, higher velocity in the real economy, and some inflation.
In terms of the rotation and your preference for things like banks over some of the growth and techie trades, Mike, if the 10-year yield stayed where it is right now, would you still like that rotation? Do you still think that continues? Do you think that higher yields are simply sort of the kicker to the trade?
Yeah, I think that's a really important sort of point we have to consider because, look, the reality is that rates, 10-year yields and rates in general is really the piece that's missing. It's the outlier. Every other asset class in the world is signaling higher growth and higher inflation. And rates have been pinned because people think the Fed doesn't want rates higher. Maybe that's true. Okay. Now, stocks and commodities and other asset prices have moved in front of that, meaning you've already benefited from a higher move in rates. That the markets have discounted what they think is going to happen. What I envision is rates going up. You get some valuation compression, maybe a consolidation, slight correction in the broader market. And then you go back to these areas that will benefit from the rate move and really growth at that point. Okay. So, I don't think that this is a problem, right? I don't think inflation is a problem. In fact, I would argue if you don't get inflation, you don't get higher rates eventually, then basically policy has failed. And that's when you have a problem.
Hey, Mike, it's Tim. I would argue that the market has largely just been responding to the P in PE because there are no earnings, or earnings are certainly been made to be inconsequential in 2020 and possibly 2021 until we normalize. So that to me is the biggest dynamic here, and I don't think a move to 140 changes that on the 10-year. What do you think? I mean, ultimately, you have to assess really the P and PE all the time, and right now, no one cares about the PE multiple. Are you going to care about it in 4 or 5 months?
No, we do care about the PE multiple. That's certainly our outlook call for this year was, our view is that we think valuations, PE, should come down by about 10%, but the earnings will more than offset that, meaning the forward earnings estimate should rise by 20%, and therefore at the index level, you go up by about 10. Now, that's okay, it's an interesting story, but the really interesting story is there's going to be stocks out there that see a greater than 10% correction in multiples as rates go up. And by the way, I don't think 140 is the target. I think it's much, much higher than that. It could be close to 2 over the course of this year if we're right about economic growth. And there's going to be stories that valuations don't compress at all, like the banks. They may even go up because higher rates and a steeper curve actually helps their story. So this is where it gets really interesting as traders or investors, and what you guys do and what we do. I mean, it's fine. This year is going to be much more idiosyncratic. It's a bull market. It's a bull market of stocks. It's not a stock market bull market.
Mike, thank you. Good to see you.
Thank you.
Mike Wilson, Morgan Stanley. Mike had mentioned the steeper yield curve in banks. Obviously, the 2-year yield has been anchored pretty much as the 10-year yield has gone higher. And Karen, what we saw today was, J.P. Morgan hitting a new 52-week high ahead of its earnings.
Yeah, an all-time high, right. I mean, it should be up ahead of its earnings. I'm not sure how much is priced in already. We talked briefly yesterday about, people expect that net interest margin to expand, which I definitely do as well. But I think there'll even be a lag effect because going into the fourth quarter, the 10-year was only at 66 basis points. Obviously, it's much higher now. And remember also, J.P. Morgan and the other banks got in just boatloads of deposits that they weren't able to deploy quickly enough. So that's going to be additional net interest income, maybe not all in this quarter, but in next year as well. Plus the rest of their businesses, the capital markets, underwriting, the SPAC business, asset management, all those are just going gangbusters. So I expect good earnings, but they're getting priced in.
Shepard Smith here. Thanks for watching CNBC on YouTube.